98% of traders fail to consistently make money in trading because they don't understand this one market structure model that I'm going to be sharing with you in this video. This video is broken down into two parts. In part one, I'm going to be using this whiteboard to explain everything about how to trade market structure properly. And in the second part of the video, I'm going to take you through a live walkthrough of real price action, applying everything that we've just learned into a step-by-step trading strategy. So without further ado, let's dive straight into the video. There are 4 key points to understanding this market structure model. The first is basic structure. The second is advanced structure. The third is multi-dimensional structure. And finally, the fourth is everything compressed into one simple to use, consistently profitable trading model. Let's dive straight in first to set the precedent with basic structure. So first and foremost, basic structure. Basic structure simply tells us the direction that price is likely to trade on based off of these external swing points. You see, if you look at any market, you will always be able to identify areas of price where you see sharp market reversals. These areas that produce these reversals are what we refer to as our swing points. So just by mapping out our swing points, we have a very good idea of the direction of price. Simply put, half of the battle of trading is just understanding which direction to trade in. Profitable trading is which direction should I trade in and where should I trade in that direction from. If you get those 2 things, you've got it. And that's exactly what you will get from this video. So first things first, we have these external swing points in market structure. And very simply put, when these points, we have a low here, we have a high that produced a reversal, that high puts in this low, and then price reverses back to the upside from that level. So this right here is the current high. This is the current low. Price comes down, fails to break this low, and then trades higher and breaks above this high. That is obviously a break of structure. So a break of structure is essentially where the next price leg breaks the previous high or the low in a bearish example, but this is a bullish example, the previous high toward the upside. Now, essentially what happens is after we break structure, price finds a agreed upon price at some level and then begins trading back down into this previous level. Then you can map out this low, which is going to be referred to as our swing low, right? This is the low that's currently in control of price. Then we have this high that produced that low. That is referred to as our swing high. Now, before price breaks that level, this is essentially all you see, right? You see these low, high, low, high, low. And then off the back of this, we already have the expectation that price is going to trade higher. And it does. And when it does trade higher, that is a break of structure. Now, again, the same thing occurs. When you see this, the expectation is already set. We're already expected to come retrace a little bit lower before eventually continuing higher to the upside like this. And then you have a higher high. So this is basic structure. Now, at some point in time, after price has exhausted a trend, because trends often go and then they reverse, at some point in time, you'll have your final move to the upside, which will give you a final break of structure. And then you'll very likely have a change of character. A change of character, chalk for sure, is simply the shift from bullish price action to bearish price action. Price is putting in higher highs, meaning this high right here is higher than the previous high. This high right here is higher than the previous high. This high right here, higher than the previous high. Then we go lower, low, right? This low is lower than the previous low. Whereas in every bullish move, the lows were getting progressively higher. So price is expected to trade higher. Once you get a change of character, now the expectation has shifted. Now you're no longer looking for bullish moves, now you're looking for bearish moves. And then you have a lower high followed by a lower low, and that gives you, again, another break of structure. Now, this is how market structure develops itself basic. And again, the purpose of market structure is to give you a clear and simple understanding of the actual direction that price is most likely to trade to. So it's very important that we understand. But there is a reality, and that reality is that the market doesn't often run in this basic structure format. Now we're going to take a look at advanced structure. The format I just showed you, which was basic, isn't actually how the market works. The market works in more of a complex structural pattern, and that is why it's labeled advanced. But the reality is the principles remain the same. So what I'm going to show you now is exactly how the market usually runs. And that is like this. The market is often producing from a low to a high, back into a low, back into a high, right? That's what we've just explained. This is basic structure. Now, just off the back, you can already see that we're bullish, right? Break of structure. We are bullish. But the reality is price doesn't move in these very simple straight lines, otherwise everybody would be able to understand it. The market moves like this. You see, these price legs actually often usually produce things like this, right? Now, that's how the market will probably look in real time. And that can be confusing, which is why so many people struggle with market structure. But the reality is, the same fundamental truths that operate basic structure also are true in advanced structure. You just have to be able to see them. You see, we have a low, we have a swing high. Price comes back, puts in a higher low, price goes away, puts in a higher high. Now, if you just see this, it's clear that we are bullish, right? Here's the thing. You have to now mark out this swing low, and you have to mark out this as your swing high. Now, everything inside from this low to this high until it either breaks down in the low or breaks above the high is internal market structure. This is where traders make the mistake, because what happens is price goes and puts in a low, and then the market starts trading backwards like this. And so these are different color for a different type of structure. So the market starts trading backwards, and then it puts in this low, and then it puts in this high, and then it puts in this lower low. And now, all of a sudden, what traders are looking at is that they're looking at these levels as their structure. And they are thinking that the market is actually bearish, right? Because price is putting in these lower lows. They're thinking that price is bearish. Price goes back bullish. They think now that the market is bullish again, right? And then the price continues trading lower again. And now they start trying to sell again, right? They start trying to sell again here, right? And so they're looking at these internal structural legs and trying to trade this. And that's where they make the mistake. Because at that point now, they keep trying to short the market when actually the market is technically bullish. And the reality is price isn't going to come and take them back into their trades, and price isn't going to disrespect this low. It's unlikely. So anything inside of this low to this high is internal structure. And that's how you need to be able to see it. So until price breaks out of this swing range, price is still bullish. We have a low down here that's respected. We have a high up here that's looking to be targeted. And as you can see, right, price goes and puts in the high, we have a pullback, and then we go and put in a new high. And that becomes our higher high. Now we have a new structural range, right? The problem is though, is like, where do you use your high? A lot of traders make the mistake of they think that, okay, this is now the low that is in control of the market. So I'm going to try and buy at this low, but then when that low gets broken, they think that now the market is shifted bearish. And so now they're trying to sell at these levels, or they're trying to sell again at these levels. And this is where they're constantly getting themselves stuck. Because they think that price should trade higher from here, lower from here, and lower from here, that's why they end up losing trades. Now, they're still trying to trade the same concept. They're still trying to understand market structure, but they're just understanding it wrong. Because the reality is that we are bullish. This right here is the swing high, and the lowest point that price pulls back before we break the high is the swing low. So this right here is the swing low. This level here is a swing low, because price goes from high down to the low, back up to the new high, and then back down again. So this is the low. Again, traders all the time make this mistake. They think that it's this low, or this low, or this low. And then when those lows get broken, now they're trying to short the market, when the reality is it's not. The market is bullish from this low down here. And so that's the low that needs to get respected. And so again, price goes higher high, comes back down, puts in a higher low, right? This low is higher than the previous low, not lower, it's higher than the previous low. And the target is always this structural level, back to the upside, right? That is how the market actually delivers structure. It is actually simple. It's just complicated for most people because they don't understand the difference between these internal swing points and these external swing points. And so it's very, very important that you understand that. Now we're going to take a look at multi-dimensional structure, which is going to give you an even deeper understanding on how to identify these swing points and what areas to be looking for trades from. So this principle is multi-dimensional structure. Again, one of the biggest mistakes that I see when traders are trying to trade market structure is they forget that market structure has multiple dimensions, right? It's not singular dimensional. What I mean by that is if you look at any time frame, right? Any different time frame that you look at will show you something different. Any time frame you look at will show you something different because a time frame is simply just a singular view of the same price action. So the market is just one existing, living, breathing organism, and a time frame is a single perspective view of that market. So one trader may say that the market is bearish right now, and he may be right. Another trader might say that the market is bullish right now, and he also may be right. The difference is that maybe they're looking on different time frames. It can exist a bearish market on the 4 hour, but it can be a bullish market on the 15-minute time frame, right? Same market, same euro US dollar or ES, whatever it is you're looking at, different time frames, different perspective. Therefore, you're looking at things differently. So if structure can be both bullish and bearish, depending on what time frame you use, then how do you combat that? And the real answer to that question is by using multi-dimensional structure. Multi-dimensional structure is essentially looking at structure through various time frames instead of just one to get a better understanding of how everything is going to react. Let's use this right here as our 15-minute time frame. Right, our 15-minute time frame is trending in this direction. So we're bullish, right? We have a break of structure in here, we're bullish. So black resembles 15-minute time frame, right? That's the 50-minute time frame. The 1-minute time frame may look like this, where you're actually having high, low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher high, lower low. Right? This is how the 1 minute delivers its structure. Different swing points. Again, if we look at just the 15-minute and we mark out our 15-minute swing points in red, you see swing low, right? Swing high, swing low, swing high. We're bullish. Now, if we look at the 1 minute structure, you might have a swing low here. In fact, we'll use 1 minute in different. So green is our 1 minute, and we're going to underline that in blue. So swing low, swing high, swing low, higher high. So we're bullish, right? The M1 is putting in these bullish price moves. Higher high, higher low, higher high, higher high, change of character, lower low. Now this area here is a very, very important area. This here is an insight area. Because what's happening here, we've reached a high point, and what we're seeing is the 1 minute time frame has just shifted bearish, but we also have the 15-minute has just put in its first bearish candle. So now what we're getting insight into is that the reality is that the 15-minute time frame is probably now coming for a pullback, and that happens. The 1 minute continues lower, lower low, lower high, lower low, lower high, lower low. The 15-minute reaches its low, and then the 1 minute shifts higher. And we have a change of character. So the 1 minute shifts bullish in this area. Now the 15-minute is still bullish, but it's in a pullback phase, right? The expectation is the 15-minute is going to continue trading higher into this high. But at the moment we're in a pullback phase. The moment that this 1 minute area shifts from bearish, whilst the M15 is pulling back, to bullish, now there's a good chance that the 15-minute time frame is going back into expansion. And in the expansion phase, price is going to expand and target this old high. Don't let that go over your head. What we're essentially saying is that structure can be bullish like this. And then on the lower time frame here, the 1 minute changes character, goes bearish. And that already tells us that the 15 minutes now coming back. And then the 15 minutes starts doing something like this, but on the 1 minute time frame, price shifts from being bearish to bullish. And that's why that looks like that on the 15 minute time frame and not on the 1 minute time frame. And we can see that, and this here gives us an edge, because now there's a good probability that we are now going to target this old 15-minute high. But we are getting the information that it's going to this high before it's even got close to the high. And so now we can build an edge off of that, just because we understand how to use multiple timeframes. So if we tie that back in to the current example that we're using, right, here in black and green with the 15-minute and the 1 minute time frame, what we can see here is that obviously the 15-minute is bullish. Now we have a 15-minute swing high and a 15-minute swing low down here. So we are bullish, we're expecting price to trade higher, but right now the 15-minute is in a pullback phase. And the 1 minute time frame is showing us that, because the 1 minute time frame is bearish. It's putting in high, lower low, lower high, lower low, lower high, lower low, right? And then the 1 minute gives us this. It goes from being bearish, putting in all these lows and breaks of structure on the 1 minute, to then being bullish and putting in now new highs. And so we haven't even come to this level yet. We're down here. But now we already understand that there's a good chance that price is going to go and attack this high. And that discrepancy, that difference, we can build an edge off of that. And that is what this market structure model is. It's about building an edge off of our understanding of market structure by using multi-dimensional structure as well. Because what's going to happen next, very likely, is that now the M1's shifted bullish, it's going to continue being bullish up to this high. And on the 15-minute time frame, it's going to look like price doing this. Just coming in here and trading back in its overall direction. So again, what do you think is going to happen next? Price is going to give us a break of structure to the upside. And then at some point in time, maybe now, maybe next, we understand when we get the confirmation that the 15-minute is going to start coming like this. And the reason that happens, and we know it, is because the 1 minute time frame does this. It goes from higher high to lower low. And the 1 minute time frame starts trading lower, like this. And the 15-minute time frame is also trading lower. And then we come into maybe some area of interest, right? Some point of interest, like this. And then the 1 minute time frame, before the 15-minute time frame does much else, shifts from being bearish to bullish. And that's our edge. Because we can buy the market here and then sell our position here in a bullish model. So that leads me into step number 4, which is essentially taking everything that we've just understood and applying it to the actual market into a step-by-step strategy. And I'll be doing that by breaking down a trade that I took on the 1st of May during a New York session, trading simply just my understanding of market structure. So without further ado, let's dive in. Now this is the trade, but we have to understand how do we actually get to the point of taking this trade. So what we'll do is we'll go back just to the area of where New York session is opening, and we'll kind of understand what was my thought process going into this New York session. So first and foremost, it's our 15-minute bias, right? Which is our structural direction. So if we kind of zoom out on the 15-minute time frame, essentially what you will see is we were actually bullish for a period of time. Eventually we shifted bearish, right? The bearish descent begins here. This high produces a low, higher high, right? This high goes lower low, so that's a change of character. This low then produces these highs, right? And that produces a new lower low. Then this high produces this low, puts in a high, puts in a low. And then we pretty much contained ourselves within this range for a long period of time. Eventually, at some point, we ended up breaking out of this range, giving us a continuation of structural development. And so if you see that we break the low down here, so this becomes our swing low, and our old swing high was where? What you have to do is, this was a swing high to swing low. So lower low, like this. Now, everything inside of this level, until price breaks, is internal. So you find the highest point that price pulled back in that price leg, and that's going to now be your swing high. So you can see here, this high right here is the highest point that price pulled back before we break structure to the downside. So that right there is our swing high. So we're trending from this high up here all the way down to currently the low down here, right? This London session equal lows. So that is our swing low. So we're obviously bearish. Therefore, as I come into New York session, I'm looking for shorts, right? Plain and simple. Now, the issue is there's many different highs in this price leg, and it only takes one of these highs. Let's say, some traders, for some reasons, they're looking at maybe any of these highs in here as their structural highs. It only takes price to do what it's just doing right now, to break this high, for now everybody to some reason believe that price is now going to trade higher, when in reality, I personally am bearish. So I'm coming into my New York session and I'm looking for shorts. Essentially, I just want to be looking at an area of interest. So right here at these London session highs, I have equal highs. So that's a pocket of liquidity. So market oftentimes reverses from areas of liquidity. And again, the key differentiation here is when this New York session opens, the most important thing is I need confirmation, because as we've already discussed, the system itself is pro-trend, right? So we are trending bearish, and then the 1 minute time frame is coming back like this, bullish. And I need to just see this 1 minute structure shift to bearish. That's going to give me my confirmation that now the 50-minute time frame is likely to trade lower. And so it's that simple. When New York session opens and it sweeps into this liquidity, which gives an additional layer of confluence, it also trades into these old fair value gaps, additional layer of confluence. I'm looking for my confirmation. And at this point, if you zoom out on the 1 minute time frame, it's pretty evident to see that the 1 minute structure is indeed bullish. We have low here, high, we create equal lows, and then you can obviously see we put in a higher high, price starts coming back, and this is the low, right? Again, many people will make the mistake and start thinking that, okay, the 1 minute is now bearish for some reason. Okay, now the 1 minute is bullish again. It's like it was always bullish. And then we break this high, and then if you look closely, what you'll see after we break this 1 minute high in here, now what you'll see is that price puts in this high, like so, and then it gives a reaction, and then it goes high, high again. So the structural high becomes high, low, higher, high, right? Very simple. This is a break of structure. So the 1 minute is bullish. As I enter New York session, the 1 minute is bullish. The swing low is down here. So if the order flow, which is all we're understanding and trying to trade, is the flow of orders in the market. And basically our job is to understand who are the strongest force and let me trade in alignment with their direction. It's that simple. So if the 1 minute structure is bullish, that means the order flow is bullish. That means demand, buyers are outweighing supply, right? So that's why price goes higher. Eventually, price comes to a battle area, essentially, where we have a battle between supply and demand. What happens in this period here is demand comes in, right? And it's attempting to trade price higher. But at this exact level, supply also comes in. And so a battle occurs. And in here, there could be a lot of volume being traded in this level. Many people make the mistake and believe that just because you have a very bullish move like this, there's more volume in this move than there is in this move. That's not necessarily the case. This could be more imbalanced volume, meaning in this level, you might have, let's say, 100 lots of buys, and you might only have 10 lots of sells. That's imbalanced. That's why price trades higher. In this area, you could have 500 lots of buys, and you could also have 500 lots of sells, and price wouldn't move. Price would just stay contained in here. So there's a huge war that's going on between supply and demand. And we're already looking for shorts because the overall direction of price is lower. So what we need to see as confirmation is this low down here to be broken. If this low gets broken, which it does, now we've confirmed that the 15-minute time frame is bearish and the 1 minute time frame is now also bearish from an important area after a sweep of liquidity as well inside of our key New York window. So that is the complete green flag to look at entering this position because the 15-minute structure is bearish. Now the 1 minute structure is bearish as well. So the direction of price is lower. All I want to do is trade in that direction. Then it comes the case of where do you get into your trade from? And so for me, what I'm looking at is I'm looking at the imbalance, right? I'm looking at the inefficiency in price delivery. And so you can obviously see there's a bullish fair value gap here. And that bullish fair value gap gets traded directly through with a bearish fair value gap. So that inverted fair value gap there, for me, becomes my area to entry because there's a decent probability that price comes back to that area to rebalance the order book. And then obviously we have the actual order block in here, right? The supply zone where the battle takes place and then supply eventually comes out on top. but I just want to make sure that I get in the market. So my entry becomes here, my stop loss becomes above this high. My stop loss and your stop loss should be an area of price, which if price trades into that level, your idea for that trade becomes invalidated. So if my stop loss is above this high, the moment that price reaches that level, now the 1 minute time frame is shifting bullish. And so if the 1 minute time frame is shifting bullish, I don't want to be in short positions. That would be my trade over. So that's where my stop loss goes. And so my target for this position is none other than the overall 15-minute trend, right? We're already bearish. This is a pullback. The 1 minute time frame has just shifted bearish as well. And so my target is none other than the 15-minute swing lows down here, which gives me a 1 to 6 risk to reward. And so it just becomes a case of waiting for this trade to tag in. The moment it tags in and gives you this type of reaction, that's the type of reaction that you want to be seeing. And so from there, it's essentially just a game of where will the direction of this trade play out. Now, here's something I will tell you, right? I can give you these trading strategies all day long. The reality is that it requires more than just a trading strategy to become a consistently profitable trader. So if that's your goal, in the link of this video, I'm going to leave another video covering the 3 things that are more important than a trading strategy if you want to be profitable.